Okay, well, let's go ahead and get started here. Um, Welcome to everyone for the Q2 um, update for Inside the Numbers. It's our privilege and pleasure today to welcome Bill with us today and um, to have him talk about the um, Southwestern Graduate School of Banking, which he's headed up now for a number of years and has been involved with Southwestern Graduate School of Banking. And so it's our distinguished privilege to have him today. And Bill, I wonder if you would mind just taking a moment to talk a little bit about the school and about uh, your time there. Just give us a little bit of your background.
Sure. So my background, I started as a banker back in the mid '80s, working for Norwest on their consumer side. After a few years of that, I decided that the life of an academic looked a little bit more interesting. But I've been fortunate for my 30 plus years to have one foot in the banking world and one foot in the academic world. Prior to becoming the president and CEO of SWGSB at the beginning of 2024. I was an administrator and faculty member at Texas State University for the previous 24 years. So, um, have taught at SWGSB for over 25 years. And so I've been a long history with this school. We basically educate community bankers and community bank directors. So our marquee program is what we just simply refer to as SWGSB, which is a 3-year program where bankers are on campus for 2 weeks for 3 years. And then in between the first and second and third year, they do a couple of in-depth projects on their banks. And if they've done them correctly, they've got a report that they can deliver to the C-suite and or the board that says, I've just looked at our credit risk management policy, for example, and here's some areas where I think we could do some improvements. So it's not just a academic exercise, but a very practical thing for them to do. One of the
Yeah,
things that I was
that's
going to say,
one of
one
the
thing that
things that I've.
distinguishes, go ahead. I'm
Go
sorry,
ahead,
Rick.
sorry. No, no, no. Go ahead.
I was going to say one thing that distinguishes SWGSB from the other graduate schools of banking, and there's a handful across the country, is that each year we also have a living case. And so we have a real bank that pulls back the curtains and allows our students to basically serve as consultants, examine the bank, ask management questions, and then provide recommendations. And so it's beneficial for the students because over their 3 years, they get to see three very different banks. So last year, 2025 was Prime Bank out of Austin, a relatively small bank. Prior to that, we had B1 Bank, a very large bank. We've had
Right.
First Financial out of Abilene. So students get a variety of banks that they get to really see how they work from the inside out. And that's a unique experience to SWGSB.
Bill, just a quick question for you. In the face of the uh, changes, the ongoing changes and evolution of the banking industry, notwithstanding the impact of technology, I'd be interested in your thoughts about how the curriculum has changed over time to adapt to and meet those needs.
Well, I'll tell you, the fundamental curriculum has not changed dramatically. So if we're talking about the fundamentals of credit, for example, those are the same today as they were, 30 years ago. But in terms of more current topics, if you will, or those changes, uh, students have during their second and third year, each of those years, they have an opportunity to select from five, or they can choose 5 different electives out of 25 topics that are offered. And so those electives are constantly evolving given what's happening in the industry. Now, some of the core courses like compliance, those have to evolve with whatever the current regulations are, et cetera.
Right.
But the fundamentals of leadership, the fundamentals of operations, the fundamentals of lending, those stay the same. So in a sense, our year one curriculum, which is blocking and tackling of banking, hasn't changed dramatically. But that year two and year three, where they get to decide these are the topics I'm area interested in, are the areas I'm interested in, that's where we see changes. So, for example, this past year we had sessions on AI, we had sessions on machine learning and modeling, in addition to just advanced credit topics. So there's a variety of things that go into those electives. Next year, one of the topics will definitely be stable coin and now that banks are allowed to do a little bit more in terms of cryptocurrencies, we'll definitely have an elective on that.
Right. Well, thank you for that update. And I think it'd be safe to say that in banking circles, Bill Chittenden is a well-known name and a person who, in addition to his duties at the school, is a speaker of some renown around the country. And you'll see evidence of that shortly as he goes through some of the materials that he's most recently developed. I'd be remiss if I didn't thank our many sponsors. You can see them on the screen there, and thank them for their support inside the numbers, but more particularly Bankers Helping Bankers, which continues to grow and prosper as a result of the support for our sponsors. Let me also just mention in passing, and Sean, you might want to comment on this, that the Roundup, which is a yearly event, well known in both fintech and banking circles. And Sean, I'll let you just comment there if you would.
Yeah, I'm actually really excited. Every year around the beginning of November, we have our FedFizz Roundup. It is great. Actually, I think pretty much every one of the BHB sponsors will be there.
Right.
It's a great opportunity, particularly for me, being selfish, to be around a lot of really intelligent people and a lot of passionate people about the industry and what they're doing, technology changes that they're implementing to enhance performance in the bank. And what's really cool is the Roundup conference is always free to bankers.
Right. Well, like you, I always hope that as I hang out with people smarter than me, some of that will rub off. I'm not sure whether it actually does, but that's always the hope.
Always worth a shot.
Right. So again, welcome to everyone. As we get into the presentation, we're first going to talk about just the banking industry. And we have just under 3,000 banks that have reported thus far. So there's still a number of banks yet to report. So this is, and I want to stress this, just sort of a preliminary look. However, we do believe that directionally, the data that we're going to show is probably not going to change dramatically from this point forward. But we will go back at when every bank has reported and do an updated version, which will be available later. If you would like a copy of this or would like to review this data again and want the presentation, you can get it at info@bankershelpingbankers.com. So with that in mind, let's launch into the numbers. And we're going to look alternatively at the last 4 quarters in some cases and the last 5 quarters in others. But as you look at asset growth for the last 4 quarters, you can see that it has not been substantial. We continue to see modest asset growth across the industry as a whole. Now, the good news here, if we look at loan growth in the current quarter, that would be the June quarter of this year, you can see that there was a not insignificant bump in loan growth. Sean, do you or Bill want to comment on that at all?
I would love to actually jump in on that just a little bit. Yeah, and Rick, you and I, we talk about this topic from time to time over the last several years. That I know a lot of times we use assets or average assets as a denominator in many of our analysis equations. But the way a lot of banks grow these days are really through digital channels, not necessarily through branch footprints. So when you see loan growth outpacing asset growth, that gives me some thoughts of where the growth is occurring in those banks, probably coming through digital channels, as
Right.
opposed to the normal. Hey, I'm gonna open a branch in a new town. So I'm pretty excited about that. Obviously, I'm very excited to see any loan growth,
Yeah.
and hopefully the loan growth actually outpaces the inflationary rates.
Bill, do you have any thoughts on whether you think that loan growth through the remainder of the year and into 26 is likely to, be flat, increase? What expectation do you have based on feedback you get from bankers?
No
Well,
pressure, Bill. Yeah,
well,
no
I think
pressure.
most bankers are optimistic about the near term future. Nobody's predicting, I think, from a practical perspective, a recession occurring, anytime in 2025. Um, Might be a little bit harder to predict out to 2026. Longer term, though, loan growth is for the most part going to mirror the growth in the economy. As the economy
Right.
grows, there's additional loan demand. And so a lot of that is going to be dependent longer term on how strongly the economy grows, or, if it shows signs of weakness, that's going to reflect in loan demand.
Excellent point. All right, let's move on to deposit growth. And here we see just the opposite impact. Whereas loan growth uh, improved in the June quarter, we saw a not insignificant decline in the percentage of growth on the deposit side. And I think it would be safe to say that banks in general are continuing to uh, be aggressive in their efforts to attract deposits. And if we look at the loans to deposits relationship there across banks, you can see that that's been I think you could call that flat.
Yeah.
You do see a modest improvement as a result of the growth that we just alluded to in loans in the June quarter. We did see an improvement from the March quarter. So we'll be following that trend and looking at that going forward. Now, the next thing we want to look at here is the percentage of growth for other borrowings. And as we look at that number, we'll see a fairly significant bump. This is one that Sean and I scratched our heads about a little bit. And Bill, I'm going to throw that one over to you just for a moment to ask if you have any thoughts about the significant growth in other borrowings in the June quarter.
Well, I think kind of big picture, if you've got loan growth is outpacing deposit growth, you've got to fund the difference from somewhere. And so borrowings are going to be the natural plug figure for that, if you will.
Yeah, that's exactly what I just got through writing down. So
Great
yeah,
minds think alike, Sean.
there you go. Yeah, I think that's bad news for you, actually.
Excellent point. Excellent point. And accumulated other comprehensive income. This has been over the last number of quarters. You can see in the June quarter last year, we see improvement from that quarter, but across the industry, AOCI remains an issue. And certainly, I think that's something that until rates begin to decline, that's going to be a continuing factor as we move forward. Now,
Yeah,
sorry, go ahead, Sean.
I was just going to say that I don't think the unrealized losses on securities story is over. There was a really good report, and I didn't put a link to this anywhere, and I should have, but there was a really good report from the Office of Financial Research about a month or so ago, maybe 2 months ago. That's part of the Department of Treasury. And they had talked about kind of the mix of securities and the stickiness of those securities, and particularly the duration of those securities that are within bank holdings. And it's really in the midpoint plus on the yield curve. And that's where we're still seeing some pressures. Even if the FOMC were to drop rates considerably, that's just going to be on the short end. And we really haven't seen that mid and long end of the long bond move much. And so I don't think that story is finished yet.
Right.
But we're still seeing lots and lots of banks restructure their portfolios through various either through borrowing monies, taking a hit, or selling off different lines of business to go ahead and restructure, and then kind of wipe that out as from that loss so that they don't have a tax payment.
Bill, thoughts on that from you?
Well, I think to Sean's point, this is not going away. Even if the Fed, like as Sean said, reduces short-term rates, at least more recently, what we've seen in response to that is an increase in the 10-year rate.
Yeah.
And so if we're looking, my guess is for banks, their average duration is going to be a little bit less than that, but they're not going to see relief, I don't believe, from falling rates. They're just going to get relief as those portfolios mature. And they collect those par values and then, reinvest at current rates. That, unfortunately, this is one where I think only time is going to take care of the problem.
Right, right. Moving along to earnings, if we look at return on assets, I think it's noteworthy that for the past now 3 quarters, we've seen improvement in ROA. And if we take a look at efficiency, now the efficiency, as you see it here, is the green line. And as you would expect, as efficiency improves, in other words, moves lower, you would correspondingly normally expect to see an improvement in earnings. And that's exactly what we've seen. And you will notice a not insignificant bump in the June quarter in total revenue. Here we're simply looking at net interest and non-interest income. And you can see that moved considerably higher, and overhead expense, which you see here in orange, stayed pretty much at the same level, just a modest increase, but certainly down from where we were in the December quarter. And as we continue, what you'll notice is that the lion's share of the improvement that we see in total revenue is a byproduct of net interest income. And you see evidence of that here. So we look at some modest increases on a quarter-to-quarter basis, but a more substantial increase in the June quarter. And certainly the hope would be that as we move through the balance of the year, we would see continued improvement there, or even if we were able to stay at consistently at that level, would be a marked improvement from where we've been in previous quarters. Non-interest income, on the other hand, you can see not much movement there, pretty consistent over time. And frankly, I just don't know that I can see anything. And Sean, you and Bill can comment. I don't know that I see anything on the horizon that would suggest any material improvement in non-interest income as we move forward. So Sean, let me turn that over to you.
Yeah, I'm kind of with you. I'm kind of stumped as to what could be a potential driver there.
I say that in the context that if we were to go back to the time that in the 2020, 21, and even into 22 timeframe, when we were seeing considerable revenue from the secondary mortgage loan market, that has pretty much dried up and does not appear to be coming back anytime soon.
Another function of rate structure, but yes.
Right, right. Bill, any thoughts on your part?
Well, I think to your point, you've got increases on the net interest income side, and unfortunately, some of that's offset by in this case, as compared to where we were, obviously in this chart, things are flat, but a slight decline in the non-interest income side of it.
Right.
So that, yeah, and I think part of it is, consumers and bank customers are more keenly aware of the fees that they're being charged, and they're willing to negotiate on those and call the bank out on them.
Right, right. Non-interest expense, again, based on where we were at year end, uh, not insignificant improvement since then, but relatively flat if you take out the December quarter and just look at the other 4 quarters here. Again, I think that would certainly qualify as flat. So I don't know that we're likely to see any material change there.
Yeah, that's actually, I was kind of impressed by that. And we'll look at some of this a little bit later, some of the economic updates. But when you have wage growth, nominal wage growth outpacing CPI, to see flat non-interest expense with SG&A being a large portion of that, that's I'm pretty happy to see it at that level. Actually, could be
Well,
significantly.
yeah, I was just going to say, if anything, I think you'll see continued pressure
Yep.
unless we see some material improvement in non-interest income. I think there'll still be a lot of pressure on expense control and even reduction. Bill?
Well, I mean, in this case, I really don't have anything additional to add, put it that way.
Okay, okay. So we take a look at the provision, that is the contribution to the loan loss reserve. You can see that that's sort of been up and down, up a little bit in this quarter, but still, I think at levels that are not of material concern at this point with regard to credit quality. And in fact, if we look at the allowance for loan loss reserve, uh, we would see that that has remained fairly constant. We don't see any effort on the part of banks to increase that to any significant degree. If we take a look at non-accruals, we do see a little bit of increase there over the last number of quarters. But again, I think not at a level that would suggest that, at least at this point, we have any significant credit issues to deal with. However, just as a cautionary note, that's something that we will be continuing to track. And again, I would like to have Bill, you, and Sean comment on what you think is likely to happen going forward, just based on the numbers we're seeing today.
Yeah, I'll take a stab at that. In conjunction with the large banks and the SEC filings that have already occurred, we're still in a really good spot. Many of the banks are touting the strength of the consumer. We haven't seen the CRE catastrophe that was forecasted for several years. Credit cards are staying in line. Net charge-offs are at rates that are very good for the industry. And I would also caution folks, if you're looking back and making comparisons, especially on NCOs, particularly with credit cards, if you look back at pre-pandemic at 2019, if you recall, was actually some of the bread and butter years when it came to asset quality. We were doing really good. And I think Brian Moynihan actually mentioned that about a year or so ago in one of his earnings announcements. So we kind of have to watch what our baseline is because those were really good years. But obviously, fingers crossed, things look good today, and hopefully they continue down that path. But I'm not seeing anything that really disturbs me. And I know about a year or two ago, there was a lot of talk about, well, credit card balances are now past 1 trillion. But if you take an inflationary adjusted number and go backwards, it's actually, we're still not at 2008 levels on credit card when you adjust for inflation. So I'm not real concerned about that at this point yet, although the trend may be a little bit more of a concern if it continues.
Bill, any alarm bells for you at this point?
Well, I think to Sean's point, the levels are not alarming at the moment, but if a year from now this trend continues and we see this at, 0.7, 0.75%, then I think, yeah, that's definitely showing some cracks in this area.
Yeah. Also, if we look at net charge-offs, a little bit of a bump from the prior quarter, but you can see that, and year end, I think it'd be safe to say that historically, you often see a little bit of increased activity in the December quarter. But if you look at the other quarters, it's interesting that they mirror each other exactly uh, over that 4 quarter period. Sean, were you going to add something?
No. I just,
Okay.
normally you're going to clean up stuff in fourth quarter.
Consistent with what we will see on loan rates, loan yields went up pretty dramatically. And with that, and with the slight increase in loans to deposits, we saw yield on earning assets improve fairly significantly on a quarter to quarter basis. And as stated earlier, this was obviously um, important, a very important part of the improvement in earnings that we saw. Here you see loan yield, and you see the increase, the bump in loan yield from the second to the third, from the first to the second quarter, rather. And that's another uh, that's another area that we'll be watching going forward to see whether we see continued improvement there as rates remain high. And then finally, if we look at cost of funds, the trend down from the September quarter of last year, we trended down now every quarter, although the pace of that decline has slowed somewhat. So that'll be important, obviously, from a margin standpoint. So overall, I think the biggest takeaway for me is the improvement in earnings that is a direct byproduct of the improvement in net interest income. And certainly, I think that's likely to be the driver going forward, with, as I would suspect, some increased emphasis, or consistent emphasis would be a better way to put it, in overhead expense. Any final thoughts from the two of you?
Take it away, Bill.
I would say, actually, my question to both you, Rick and Sean, is the increase in interest income attributable to new loans, or is it the repricing of existing loans that, had been they've got a 3-year reprice on them, and now all of a sudden they're finally getting repriced? Or is it
Hopefully
that
it's both.
hopefully, but I
Yeah.
wonder how much of that was being brought, was that average, that yield is brought down by the loans that were made, again, let's say 3 years ago when rates were a little bit lower, that
Yeah.
are finally getting repriced to market rates today.
Yeah, obviously there's some of that. Especially if you look at Wall Street Journal prime rate at what, 7.5, I think. So we've still got some room to run on the yield side. So there's that, and I think also last quarter Rick, I think we were a little bit surprised that we did see yield on loans tick down just a hair. So that had to have been some type of a loan mix type scenario, just like what Bill was talking about.
Bill, I think given the modest growth that we've seen in loans over the last number of quarters, um, I would be inclined to think that it was more what you said, that there was repricing involved. And of course, we don't have a way of knowing that from the data that's available to us. But if I had to go one way or the other, I would say it likely has more to do with repricing.
And that if there's any concern that I hear from bankers is that when they have to have that discussion with their customer that their loan's going to reprice and now it's going to be 250 basis points higher than it currently is on whether or not that loan's still going to be able to cash flow or not. Those are the difficult discussions that I've been hearing about.
Yeah. Well, and I think that's a very excellent point, Bill. It would be interesting to know, um, you know, just how many of those loans, and obviously that'll eventually be reflected in the non-accruals, if in fact that turns out to be the case, that they won't cash flow at that higher rate. So I guess that, I guess what we're saying is that that higher loan yield could be a two-edged sword
Yeah.
at some point.
Yes.
Okay, now we get to the really good part, which is Bill Chittenden.
We can turn Bill loose.
We get to turn Bill loose and let him regale us with his industry knowledge. So, Bill, I'm going to turn it over to you and let you talk about the information that you put together for us.
Okay. Well, in terms of the economy, we measure the economy as gross domestic product, the value of all the final goods and services produced in the United States. And so, just as a quick breakdown, you and I make up close to 70% of it. We spend about two-thirds of our money on services, about a third of our money on goods. You can see business investment makes up ballpark 20%, and then government spending about 17%. These are the percentages from the first quarter. We'll talk about the second quarter numbers in just a moment that just came out this morning. But the big driver, and if you can go to the next slide, on the negative growth, the economy shrank by 0.5% during the first quarter. The huge driver for that was the massive increase in imports during the first quarter. So firms were trying to get ahead of the new Trump tariffs that were going to be put into place. And if you can order before the tariffs go into effect, you get those costs at a lower, or those cost of goods sold at a lower cost. So huge increase in imports during the first quarter. And we've seen a flips of that during the second quarter. So
Yeah,
during
I'm going
this,
to let Bill, if I might, we inserted this slide. This is one
Yeah,
that
I snuck in
Sean
here.
had put together, so
yes,
we sort of snuck this one in on you. So, Sean, you might just want to comment.
Now, sorry about the really small font, but down there at the bottom where I source, I've got a little inspiration from Mr. Bill Chittenden and SWGSB. Yeah, so I saw something that you had prepared a couple of quarters ago, and I was like, "That is awesome!" So I mirrored it and updated it. But this slide right here, what I did is I looked at first quarter GDP from the advanced estimate all the way to the third estimate and what changed. All right, so we actually went from 0.3 or negative 0.3 down to negative 0.5, and really it's worse than that if you go out 2 decimal points. It was 0.28 to 0.51. And the big driver, obviously, the decrease in the imports was actually positive, but the consumer spending is what really that really piqued my interest, and that made me question: do we have cracks here that are starting to emerge from the group that carries 67% of the gross domestic product? Because that was a big drop, 90 basis points. And then, of course, this morning we did get second quarter GDP. The advanced estimate came out. We've got a nice bump up there, a surprise of 3.0%. I think Atlanta Fed was forecasting around 2.5, and most everybody was in the 2.5 range, which was kind of a normalization of what Bill was talking about a moment ago with the great pull in of inventories. And again, I just kind of want to caution everybody that this is an advanced estimate. There's two more estimates coming. So there will be a lot of changes as more data becomes available. And it is very possible that we're seeing tariff-related impacts still, and these may reverse later on in the year. So I think the word that we'll probably hear more and more is continued uncertainty. Even though it's not as cloudy as it once was, it's still, we're not 100% yet. So,
Bill, were you surprised at the bump there?
I think I was surprised that it was 3%. Said most folks, including the Atlanta GDP, were looking for most of the last few weeks at about 2.5%. Their estimate had bounced right around there. And again, the two big things that really drove this are the reversal in imports. So we had far fewer imports than we'd had during the first quarter. So imports are a drain on GDP. So if you have fewer imports, that's good for GDP. The other thing that contributed to um, GDP was the growing of inventories. And so you've got companies that have built up their inventories, which means that they haven't sold it yet, but it's been manufactured, it's been produced, and it's going to be sold. So my guess is that during the third and fourth quarter is where we'll really start to have more of what our long-term normal is going to be in terms of what's happening on the investment side from businesses' perspective, either investing in new property, plant, and equipment, or investing in inventory, and what's happening in terms of consumer spending. In terms of that 3% that we've got, close to 1% of that is due to consumer spending, which is 3 times what it was during the first quarter.
Rick, if you'll bump us forward, I think we've got some of that data in there. One more slide up, Rick. There we go.
Yeah, there we go. So that's exactly what I'm talking about. So business investment, since we've got this increase in inventories, we don't see, or rather, we've got, my mistake, what we have is a decline in the inventories. And so those inventories are coming down. We're not producing. So companies are selling them, and they sold these inventories during the second quarter. They didn't produce them during the second quarter. So that, with those inventories going down, that's a reduction in GDP. Of course, long term, it's good for us that we're trying to get federal spending, I won't say under control, but at least reduce the growth of it some. But that's going to be contractionary in nature. We saw that the government makes up, a big chunk of the economy, and if they're going to spend less, then, that's going to reduce economic activity. But the big thing there is the positive contribution to imports. And so this huge reduction in imports you can see everything else the same, we would have had 5% growth just because of the change in imports. What is a little concerning, although it's only a little negative, is exports, that we saw a decline in exports. And so I don't know if this is an early indicator of some of the retaliatory actions that we might see from other countries in response to the additional tariffs that are being placed on them. Again, there is that uncertainty that Sean talked about. Maybe it's a little less uncertainty. Even with the clarity, it's important to understand two things. One, tariffs are a tax, and you and I pay the tax. Ultimately, or truly, it's the importer that pays the tax. It's important to understand, no matter how many times certain people will say foreign countries pay it, they do not. That is factually inaccurate. It's the importers that pay the tax. When you go to glitch your goods at customs, guess who writes the check to customs? You do. Now, who ultimately absorbs that? It could be the foreign producer. It could be the domestic importer. It could be that they pass the price on to you and I. And we've heard that Walmart said that, that they're going to pass those costs on to the consumer. So we're going to start seeing some of that down the road. Again, going back to this, we've got this huge swing in imports. Again, I think next quarter things will start to normalize a little bit. But the point I was making is that tariffs on average before Liberation Day were about 2.5%. It looks like they're going to settle around 15%. So when you've got a 6-fold increase in tariffs, you're likely going to see an increase in prices.
Yeah, and again, I was very happy to see the GDP number too, and obviously imports drive that. I did put a note down here on however, and you're going to have to keep me honest here, because I will veer off track if it's not guided. But the second quarter real final sales to private domestic purchasers, I look at that as almost like core GDP, right? That's consumer-driven GDP.
Yes.
It's at 1.2% versus a downward revised 1.9% for first quarter and 2.9% in the fourth quarter. That trajectory right there gives me a bit of a pause. And even though I say, hey, no cracks here yet, not yet, that is something that I'm watching very, very closely.
Well, look, in the interest of time, let's move on. I think I believe it would be safe to say that um, it's going to be difficult to predict just exactly what's going to happen in the subsequent quarters, just because there do remain a lot of uncertainties at this point.
Yeah. And so we can see, yeah, last week the Atlanta Fed was forecasting 2.4% for what we just saw actually ended up being
Right,
3%.
right,
And so on the employment front, I mean, overall, jobs look good right now in terms of the unemployment rate. Here in Texas, we're at 4%. Nationwide, we're at 4.1%. We last month there was a slight uptick, to the, by 0.1% on the national rate. But by historical standards, you can see over the last 30 years, other than right prior to COVID, I mean, these are historically low unemployment rates. Nobody
right.
has really ever complained about a 4% unemployment rate. So we're pretty close to what, economists would refer to as full
Full
employment.
employment, right.
In terms of number of jobs out there, almost 160 million jobs. You can see that that's, a huge increase from where we were just prior to COVID, and particularly when we had that huge drop there with COVID, where we'd lost 22 million jobs in a single month. We lost 8.5 million jobs during the entire Great Recession. And during COVID, we lost 22 million jobs in a single month. Now we rebounded in that month after we got 5.5 million jobs back, but we were down still 16 million jobs. But luckily we recovered quickly. And so overall job growth's been okay. Job numbers will come out on Friday. We'll see if you can go to the next slide. We can see how many jobs have been created per month. And unfortunately, the trend has been downward post-COVID, where we were creating, over 900,000 jobs a month. Last month, it was 147,000 jobs. The estimate in the Wall Street Journal this morning is we'll probably be close to 100,000. I always take those with a huge grain of salt. Any of these estimates are what we call swag, just scientific wild ass guesses. So, that they've got a model, but it's still a guess at the end of the day.
Right.
But I mean, even if we've got 100,000 new jobs, that's still positive job growth, which is, I think, good. The one thing that's of a little concern is that continued decline in the labor force participation rate. Again, it's been going down since about 2000 because of baby boomers. Baby boomers are retiring, and you're considered to be non-participating if you're retired, for example. So to be participating, you either have to be currently working for pay or actively looking for work. And so those that are retired, those that are stay-at-home parents, those that are, say, full-time students that aren't working, all of those are the non-participating folks. And with a larger percentage of our population retiring, we've seen that decline. Of course, there was a huge drop during COVID. It's recovered some since then, but we've still got this long-term trend. If you go to the next slide, one slide that I often have in here is there's only two things that contribute to GDP growth, and that's either more workers or increases in productivity. And particularly until we have comprehensive immigration reform in this country, we're not going to see enough natural born workers. And so then the only other alternative is either you have immigration reform to get workers that we want in the country to do the jobs that are needed to be done, and or increases in productivity. And that's what's going to drive GDP going forward. If you just look at our natural birth rates versus death rates in the US, without immigration, we've got a shrinking population. We see issues of that over in China. We see issues with that in Japan. China's going to have huge problems. You can do that math. You got two parents, you got a one-child policy. You don't have enough folks to replace the existing population. They're going to have huge challenges with that. In terms of price levels and inflation, these are the monthly numbers for the last year. If we went back 1 month, the May number of 24 was also zero. So for May of 24, there was zero inflation. And this is a little oversimplified, but basically your annual inflation rate is adding these numbers up. Technically, they compound them, but if you add them all up, just think of the math. If you're dropping zeros off and you're adding something that's greater than zero, the total has to go up. And so to see a surprise in terms of, or you shouldn't have been surprised to see an increase in inflation during the previous month where we jumped to 2.7%. Once we get past January, the nice thing is that 0.5% for that single month will fall off and we'll likely start seeing declines in GDP. So both the CPI and PCE are at 2.7%, obviously well above the 2% target for the Fed. Real quick, that difference between the CPI measure and PCE measure. CPI looks at a constant market basket of goods. So what that means is on the first of the year, you went down to the grocery store, you filled up your basket, and then the rest of the year you buy exactly that same basket and you simply track the change in the price. For the PCE, it uses a current market basket of goods because it understands that your buying behavior may change given a change in prices. So if beef goes way up in price, you might buy more chicken and pork. So it looks at what did you buy this week and what would that same basket have cost on January 1st. Over time, they tend to move together, but there can be some disparities, and you can see that over time. They generally move in the same direction, although the CPI, particularly since it's including everything, and PCE is the core, which excludes energy, and food and energy, it's a lot more, not nearly as volatile as the CPI is. But over time, they go together. Point is, we've got relatively strong employment. We've got inflation that's higher than what the Fed wants to see. There's no reason for the Fed to talk about changing interest rates today, and we'll get to that here in just a moment if you go to the next slides or so.
There's another one I snuck
This
in.
this was another one, Sean, that I think we inserted
Yeah.
Bill.
And it really reflects a lot of the same. I just have a nice purple line in there that shows the primary credit or the rate, the FOMC rate right now. We are still in a restrictive policy. And then again, the Fed is still saying we're data dependent. We're going to have to wait and see. There's uncertainty around the tariffs is diminished, but still remains elevated. And then that long run to SEP, the summary of economic projections, what we used to call the dot plot for us old guys. The quote from last week or last Fed meeting was that nobody really takes that with any real conviction. It was just a kind of a scattered guess because we're not really sure where we're going to be 3 years from now based upon rapid changing economic environment. And then,
John, I'm going to,
yeah,
go ahead.
I was say the good news is we've still got nominal wage growth outpacing inflation, and that's good. For those of you that are getting it, they're in that park, you're fine. And you can have wage inflation, which can cause a problem. But as what Bill was saying earlier, the FOMC looks at this as basically full employment, and there's not really a significant inflationary pressure in the wage growth, and it's actually declining a bit if you look at that green line.
Yeah, I'm going to skip ahead.
We're about 11 minutes left. So.
Yeah, I want to skip ahead to rates, and Bill, we're probably going to have to go through this faster than you'd like, but there's some really important stuff here, I think.
Well, and if you go ahead and just jump to the next slide, and you look at when we've got that inverted yield curve, and you go back further, it's the same thing. Those gray bars are recessions. You've got that inverted yield curve right before a recession. One thing I think it's important to point out is if you saw me giving this type of talk in fall of 2019, I was saying we need to be worried in 2020 that we may have a recession coming. Now, obviously, COVID did not cause the inverted yield curve, but I would contend that COVID either masked and or accelerated the recession we were likely going to see in 2020 anyway. We've had this inverted yield curve for quite some time. It became uninverted if you look at the 10-year versus 3-month for a little bit. The problem is the economy hasn't cooperated. It just refuses to go into the recession that the inverted yield curve has been predicting for the last 2 years. I think part of it is because the Fed's much more involved in the long end of the curve. Again, if you use their model, they're saying that there's a 28% chance or 29% chance by this time next year that there'll be a recession. But also take with a grain of salt that a year ago, they said that there was a 56% chance that we'd be in a recession by July of 25, based on the shape of the yield curve 1 year ago. And then in terms of monetary policy, again, this is from just a couple of days ago, but the markets are saying there's almost no chance that the Fed's going to cut rates today. And I agree with that 100%. The next slide will look at what the markets are saying about the September meeting. And here, well, there's about a 1/3 chance that they won't cut rates, almost a 2/3 chance that they will cut rates by 25 basis points. And then if you jump ahead one more slide to where the market thinks we're going to be in December, you've got the plurality there that there'll be a 50 basis point cut between now and the end of the year. But still pretty kind of normal looking curve there in terms of those guesses around that mean. And again, the Fed's dot plot, and again, this is not a good predictor. We'll get another one of these in September, but who better to ask to guess on this than the folks that are actually going to vote on what the rate's going to be? So although it's not a perfect predictor by any means, this is the best source on what are you going to do going forward. And they're still looking at a 50 basis point decline by the end of the year. And then on
And
the
this
fiscal
is-
policy, oh, go ahead.
No, I was just going to say that fiscal policy, this is where I really, really wanted you to be able to spend a few minutes. So go right ahead. This is
Well,
really interesting.
And exactly to that point, it's not politics, it's simply math. And so regardless of what administration's in charge, I would be talking about these same types of things. So for calendar year 2024, we brought in $4.9 trillion in tax revenue and spent $6.9 trillion. Gives us a $2 trillion deficit. So far, I think the verified DOGE savings close to $72 billion. And so earlier we were talking about that for you and I, $1 billion is a lot of money, but for the government, it's really not a lot. If you go ahead and go to the next slide, if you cut off all those extra zeros to put it in perspective, it's like having $4,900 in income. You spent $6,900, so you've got a $2,000 deficit, and you found $72 in savings. Not that $72 in savings is bad, but you can't pretend that it's going to take care of the entire problem.
No.
In terms of tax revenue for calendar year 2024, you and I paid almost 50% of that $4.9 trillion. You can see customs and duties was only $79 billion, or about 1.6%.
Well, you should expect that one to increase considerably, though, right? With the tariffs.
Right. So it's expected to be probably closer to $300 billion. But again, $300 billion, even if you use that to perfectly offset individual income taxes, it would still be $2.1 trillion.
Yep. Yep.
And so if we go to the next slide, we look at what we're spending money on, the top 6 areas. You can see Social Security number 1 there. Then we got Medicare, health, which is Medicaid and other health programs, net interest on the debt, national defense, and income security. So unemployment, food stamps, those types. Right. That's 85% of the budget. So if we go to the next slide, everything else is only $1 trillion, and it's 15% of the budget. We've got a $2 trillion deficit. If we got rid of everything outside of those top 6, we still only be halfway there. And so as I've been quoted as saying before, the math isn't mathing. You can't balance the budget without doing something to either the tax side, and although we all love tax cuts, and we all like more spending, that's not going to balance the budget. I understand I could lose a few pounds. I also know how to do it. I could eat less or exercise more. Neither of those are attractive alternatives. It's the same thing with the budget. We either need to increase tax revenue or we need to decrease spending. And even with the big, beautiful bill, it didn't do either of those. It cut taxes and increased spending. In that the deficit is still going to increase by a forecasted $3 trillion over the next 10 years. So we're not taking care of the problem. We're simply adding to the national debt. Every single president, has added to this. It took us all the way from Andrew Jackson, that was the last time we had zero national debt, to Jimmy Carter to get our first trillion. And you can see it almost tripled under Ronald Reagan, increased significantly under Bush 41, increased significantly under Clinton, not quite doubled under Bush 43, nearly doubled under Obama, increased significantly under the first Trump administration. And then by the end of Biden's term, we are at 34 trillion. This is closer to 36, $37 trillion today. We are on an unsustainable path.
Well, Bill, I think my biggest takeaway from today is the math isn't mathing.
That's right.
I'm gonna attribute that quote to you, but I'm gonna start using that one.
And so, just to wrap it up for me, Rick, is particularly on the fiscal policy side, we need folks as elected officials that have some intestinal fortitude to do the right thing. Give you one, I know we're almost out of time, but one quick example. Probably heard Social Security trust funds going to run out of money sometime between 2033 and 2035. That doesn't mean that they can't pay Social Security. It just means if they don't do anything, that they're only going to be able to pay somewhere between 75 and 80% of the promised benefits. So grandma's Social Security check is going to be cut by 20% at a minimum if Congress doesn't do anything. One thing they could do is eliminate the annual cap on earnings subject to Social Security tax. That would take care of 75% of the projected shortfall. But guess what? Nobody's going to do it because nobody gets reelected by saying, I'm going to increase your taxes. But the only way to fix it is to reduce the spending on Social Security, cut grandma's Social Security check, and or increase the taxes on it. And nobody gets elected or reelected campaigning on that, even though it's the most fiscally responsible thing to do.
Excellent point. Sean, any final comments or thoughts on your part?
No, I think that pretty much covered it. I mean, hopefully we do see some impact, some positive impact from tariff revenues on that. But it is, to Bill's point, it's kind of a drop in the bucket, and it's a consumption tax. So that's another pressure point to the consumer that carries a big portion of the economy.
Bill, I know this is an imponderable and certainly not one that any of us could answer with any certainty, but given the current path fiscally, you wonder, where do we reach maybe a tipping point out there? What would cause us to reach a tipping point with regard to the impact of the math isn't mathing?
Well, I think there's two ways of looking at it. One is, the debt as a percentage of GDP. And so we're well above 100%. And if you remember during the financial crisis, we were concerned about Italy and Greece because they were at 120% national debt to GDP and they were about to go bankrupt. And so there was a talk of austerity and all these things. Now, I'm not suggesting we have the same economy as those countries, but as we approach that same amount, we are somewhere getting to that tipping point. The more practical and impactful part of it is looking, the bigger the debt is, the more interest we have to pay. And that percentage of our budget that goes to just the interest on the national debt is increasing and increasing. So at what point are taxpayers going to say enough is enough because there's going to have to be cut in other government programs or higher taxes to fund the government if the interest portion continues to grow?
Right. Well, I think that's a great place to end. Bill, I think before we do, though, we'd like to reserve the right to get you back maybe later in the year and, see how things turn out based on some of the things we can see today, based on what we'll know either late in the year or maybe the first part of next year. So thank you so much for participating today and bringing all the excellent insights and information that you did.
Yeah,
Sean, any final comments on your part?
Everything you do at SWGSB too. Yeah, thank you.
Yeah,
well,
right.
Thank you all for the opportunity to share my thoughts. And anytime you want to have me back, I'm more happy to join you.
Thank you so much, Bill. With that, we'll end our session today. Thanks to all of those who participated. Once again, if you'd like to have a copy of the presentation, let us know and we'll be happy to share it.